Good afternoon and welcome to the Coinbase Institutional Markets Call. It's Tuesday 16th at midday. And wow, what a weekend we have had. We kind of traveled a long way to kind of go nowhere, but we're going to be covering all of that in the show around the market movements, as crypto is one of the only markets open. So we saw some pretty dramatic moves over the weekend, a subsequent recovery, and then unfortunately a move lower again. We are going to touch upon what's going on in the BTC space. And David, actually would love to bring you in here. You look very closely at BTC. We obviously have the halving coming up quite soon. I guess what's the latest there? What's the latest in terms of timeline and maybe what's just going on in terms of the BTC ecosystem?
Yeah, sure. I mean, the halving is very exciting. It's supposed to come up end of day, April 19th or early April 20th UTC time. You know, the hash rate keeps changing. My guess is we might see on April 20th, early morning, just because it's crypto. So that's really exciting. I still think, like I mentioned last week, the halving is not going to have a huge short-term impact on markets, but it does represent something meaningful. With the halving at current Bitcoin prices, it's around $10 billion of less Bitcoin minted per year. If we had no halving and somebody came along and said, hey, there's a new market participant going to buy $10 billion of Bitcoin per year in perpetuity, that would be incredibly bullish. So I think the halving is something to remain constructive through, but also, like I said, not something that you'll see, instantly overnight. You're not going to have a supply crunch, but halving is very exciting.
Yeah, that makes a ton of sense. It's funny, we're not getting a ton of conversation around it. But to your point, when you frame it like that, I mean, everybody loves a new bar of 10 billion. I mean, that helps any asset class, no matter what the size. Cool. Thank you very much, David. So we're going to be running through that. We're also super excited to have Zaid Khan, head of EMEA Financing Trading, joining the call. Zaid and the financing team are going to be joining us more frequently going forwards. Prior to Coinbase, where he's been here about 2 years now, Zaid was at BAML, where he was working on various parts of prime brokerage financing. And fun fact, him and I, and Usman as well, actually, who's been on the show previously, we were on the same floor when we had a few less grey hairs and maybe looked a little bit younger. But we're now all in crypto, so the grey hairs come pretty thick and fast. We're also going to be joined by Ryan Yee on our corporate ventures team. He's going to run through an update on the wallet ecosystem. There's a ton of new exciting updates there, which he's going to run us through. He's right on the vanguard, so it's always great fun listening to him. But before we get to a market update, some quick housekeeping as per usual. If you're watching on YouTube, don't forget to scan the QR code. If you're listening, then it will be in the show notes. But David and David have fantastic research, which is all free of charge, as well as the CES team that publish market updates. So check it out. It's some of the best reading in crypto, and it's all free of charge. And then lastly, no matter where you view us, listen to us, or any other ways you get us, please don't forget to like and subscribe. It helps others find out about us too. But to a market update, Greg, I want to bring you in here. At the back end of last week, we also saw the Wells notice from the SEC to Uniswap. That I don't think was entirely unexpected, and there was a market reaction to that. But then we saw bigger events happening in Israel and Iran, around the Middle East, and some of those geopolitical tensions really forced some dramatic changes on our market. So let's start there. Can you just give us a rundown of what happened over the weekend and perhaps where we are now?
Yeah, it was a very busy weekend, as you can imagine. And, the interesting thing about this weekend was really the events in the Middle East happened after traditional markets closed. So crypto is really one of the only ways that traders and investors had to express different views on risk. Our desk was very busy, Friday night, through right now, really, through the entire weekend. Interestingly, on our desk, notwithstanding the price action, which was, pretty extreme, Bitcoin traded, down to 61,000, I think actually 60 at one point, ETH broke 3,000. Flows on our desk were skewed almost completely to the buy side. We saw accounts of all different stripes coming in, really trying to pick up tokens that they viewed as trading cheap. And interestingly, we also saw funding rates that I think Zed's going to take us through come in quite a bit, basically to zero. And a lot of investors and traders took that as a signal that a lot of the leverage in the market had been cleaned out, which was another reason why they were, comfortable stepping in to add to some of their positions.
So we traded down pretty quick from 67 or so down to 62, and then we traded back up to 66 yesterday. And now we're back down at 62. Like, what? How should we read into that? Like, it feels like from a geopolitical perspective, it was quiet, and then maybe it's not.
Yeah, it's interesting. So the first move down over the weekend was really around geopolitics and the potential for outbreak of war in the Middle East. Since then, since those events have really calmed down, now the narrative and the focus has shifted to higher rates for longer and what that means for risky assets. And now we have traditional markets open again. We're seeing stock prices weaker. Crypto is weaker. In sympathy with that.
Yeah, there's certainly a lot of concern in the US, particularly around the Middle East. And in fact, with Token 49 this week, I heard of a number of people cancelling going to the event. What with that, and I think the biblical rains they've got there at the moment, it's not quite as sunny as we'd expect Dubai to be. But just digging into the market a little more, Zaid, would love to bring you in and welcome to the podcast. You're first, so good to have you here. And we'd love to dig into kind of funding rates, liquidations. It's an area that you look at very, very closely. What was happening there over the weekend and how we set today?
Hey, Ben. So I think as we've seen on a lot of the sharp moves this year, a flush out of leverage played a big part in kind of exacerbating those moves on the upside and the downside. So this weekend was no different. We saw over $1 billion worth of liquidations on the weekend. And this was on the back of $900 million of liquidations on Friday. So $900 million of liquidations on Friday. We had people gear back up with their leverage and then get wiped out again on Saturday. And then we've actually got a slide on some funding rates on the Bitcoin and Ethereum funding rates. But in connection with this flush out of leverage, we've seen funding rates really come down to near zero levels right now. They flirted with negative on Saturday. And haven't been negative since October. So that's definitely a reflection of the bearish sentiment that we're seeing. And the rates at this level definitely point towards the shorters kind of winning the battle versus the long holders. And
when you're speaking to your financing clients now, how are they thinking about it? Have you still got, is there demand for Bitcoin? Have rates there increased? Are people looking to short? Or at this level here, do people feel like it's fairly priced and are slightly more sitting on their hands?
Yeah, I think from our clients' perspective, institutional players, we've seen the positioning was very different to where retail was. So we didn't really see any real activity when it came to margin health. People had a lot of margin excess coming into the weekend. They withstood the market moves quite well. We did have people take both of those positions on the weekend. So come in for financing to sell, but also come in to buy some of that dip as well. And I think right now we're seeing a little bit of caution from our clients. So wait and hold right now.
Yeah, and Greg, would love to bring you in here. So obviously you speak with clients a ton day in, day out, and a lot of the themes are typically macro related. What are some of the other things that we should be thinking about as people look forwards in terms of how the market may move from here?
Yeah, it's a good question. So I would say, by and large, the folks I speak to are still very constructive on the market. Even over the weekends, maybe they quickly look to de-risk, but then, as prices, got down to 61,000, around 3,000 in ETH, and similar levels in some of the altcoins, we saw much more buy interest. So I think generally the sentiment is okay. As Zed said, a lot of leverage has been cleaned out of the system. That's a good thing going forward. And, now we may want to add to our long positioning. Now, that being said, we are going into a tough seasonal period. There's that old adage, sell in May and go away, that generally refers to the stock market. But you can sort of take that for any risk asset. And that's something that folks are, being very cautious around. We've had this really massive run so far this year. People are still constructive, but you need to be careful. And that's why we're seeing the buying that we are seeing is, relatively passive. Nobody on the institutional side is levering up to irresponsible levels again, as Zaid mentioned. And really they're picking their spots.
To David, it sounds like so far the initial move was focused on the geopolitical side of things. We had a kind of a recovery, and we've now retraced again, and the focus is on rates and what that outlook looks like. What are some of the things that you're keeping an eye on to help us determine what happens with regards to rates and may kind of indicate the direction of travel for our market?
Yeah, definitely. There's been a lot more discussions around higher rates for longer. There's a big question around liquidity. On the one hand, because inflation is coming back, or looks like it's coming back. We've had higher than expected inflation for 3 prints in a row now. Powell will be talking on May 1st, so that's definitely something to keep an eye on. So on the one hand, you have this story where there really is no real reason for the Fed to cut rates if you're looking at purely economic data. On the other hand, you look at kind of the continued weakness in the commercial real estate market. You look at the ballooning national debt crisis in the U.S., and you have these other more fiscal matters where there is a good reason for rate cuts outside of just purely the economic side of things. So I think you're kind of in this weird limbo where you have very good reasons both to cut rates and to keep them high for quite a bit longer. So I think there's a lot hinging on the Fed talks in about 2 weeks.
Interesting. And moving on to maybe some positive things, hopefully, that might sustain the market a little bit. So we've got a halving this week, and then there's news around Hong Kong ETFs. Maybe let's start there. David, I know you spent 8 years or so living in Hong Kong, so you have a good understanding of that market. There has been some slight negativity about how important these ETFs are going to be, but curious, how are you thinking about the ETFs? Like, where are we currently with Hong Kong ETFs, and how do you think they could play out?
Yeah, I think we're quite early on Hong Kong ETFs. So where the status is at right now is the SFC, which is the Hong Kong equivalent of the SEC, has given conditional approvals. That means that there still has to be a listing process to go onto Hong Kong Exchange. It's going to take at least a few more weeks. I'm kind of in line with some of the consensus in the short term where the initial inflows might not be very large. What I think has been a little bit overlooked, though, is in the coming months or years, if there is enough liquidity and depth in this market, the Hong Kong spot Bitcoin and Ethereum ETFs could theoretically be listed on the Southbound Connect. So the China Southbound Connect, for context, is a way for products listed on the Hong Kong exchange to actually be opened up to qualified investors in mainland China through their Shenzhen and Shanghai exchanges as well. So I think this could theoretically unlock a large pool of capital, not immediately after approvals, but it is a very positive sign that Hong Kong is trying to become a crypto hub, and Hong Kong, so far as it's part of China, might also allow more access to these products. So that's something to be more bullish on in the kind of months scale rather than within the next coming weeks. But I think it's a very positive regulatory signal.
Perfect. And assuming they grow, they start, and we're looking for this Southbound Connect. Is that correct? It's Southbound.
Yeah,
Connect?
that's what it's called.
Yeah. Okay.
That's right.
So what are you going to be keeping an eye on to understand if that gets approved? Is it just a regulatory thing that will hit Bloomberg and other news sites, or do we need to look somewhere else?
Yeah, I think it's going to be a regulatory thing that you'll see. There's not going to be any immediate news around this. Most listings on the Southbound Connect first have to meet certain liquidity and regulatory clearances. So you have to get the product listed on Hong Kong Exchange first. Once that's up and trading, then you might start to see some of the initial early filings for this. But that's going to take maybe at least a few months after trading. One thing I do want to mention, though, that I do think this is important, is that if we look at I pull up a slide, which is kind of Bitcoin returns by market hours, you actually see that since US spot ETF approvals, most of the returns have actually come from outside of US hours. I mean, the events over the weekend occurred during US market hours on the weekend, so not necessarily. This includes all days, including weekends, but you actually see a continued strength in the Bitcoin markets outside the US, and I think that that's something that we as US-based investors and a company also should be cognizant about, which is, yes, Bitcoin can be seen as a risk asset here, and definitely a risk asset all around the world, but more and more people globally are seeing the value propositions of of Bitcoin as a digital gold.
And I think this is really interesting and a good point you bring up, because it seems like U.S. investors have really ignored the Hong Kong ETF news. We didn't see as much, not even excitement, but interest in it as I would have expected. And when you couple sort of that disinterest with the fact that a lot of the returns for Bitcoin are coming during non-US hours, there seems to be a little bit of a disconnect. And if we're not pricing in the appropriate things, then there could be an opportunity there.
Yeah, certainly. I think the Hong Kong ETFs are also a big regulatory leap forward. So the creations are done in kind, not only in cash, like they are in the US. And they also have both Bitcoin and Ethereum. So there's, not necessarily going to put a lot of pressure on the SEC, but it's something to kind of look forward as a global example of where these things can go.
Yeah, it feels like that's a huge step forward. If we assume that what happens in Hong Kong is certainly mainland has a close eye on, and we look at the mining ban from sort of 2020, and then you think you've got ETH and BTC ETFs, like that's a pretty big step forwards. Worth mentioning, Eric Balchunas from Bloomberg suggested that he thinks only about $500 million of AUM would get into these ETFs. So we've definitely got a kind of slightly more bearish perspective. Let's hope he's wrong versus what we might see there. I guess sticking on Bitcoin dominance is something that you've spoken about a lot in the past, and with the context of geopolitical risk and the rate environment, I'm curious, David, how you're thinking about BTC dominance.
Yeah, definitely. So Bitcoin and to an extent Ethereum dominance has just been on a continuous uptrend since about mid-2022, and it doesn't seem like it's slowing down. I think there's two parts of this. The first part, as we talked about earlier, with higher for longer rate cuts and the general impact to risk on assets like some equities and stuff, you're going to see, especially the alts, get hit harder than you're going to see Bitcoin and Ethereum, just because of the nature of the leverage and the risk on nature of these assets. At the same time, I do think that Bitcoin is probably the only crypto with that store of value, digital hard gold narrative. So you're going to have this subset of investors who might continue to buy Bitcoin, even as some of the higher risk on alts show weakness. So I do think that we might see continued Bitcoin dominance going forward throughout this year as we get more and more closer to elections, as we see maybe the risk of reflation, and also as we see just more and more geopolitical uncertainty in the world.
Yeah, just looking at this chart here, we've got BTC dominance around about 58, 59%, and then ETH probably accounts for 10 to 15%, stable coins, I guess 5 to 10, and then the rest remains other things. It's quite interesting contrasting that versus 2018, where BTC dominance was around 30%. I guess that was the end of the 2017 cycle and ICO mania, which is obviously retrenched pretty quickly. But Greg, from a trading perspective, are we seeing that in the flows?
Yeah, I mean, we are. Bitcoin really, continues to steal the show, especially, with the larger, institutions that run more capital. On the altcoin side, we're not really seeing a ton of new money come into that sector. We're more seeing folks, and we've talked about this before, trade around sectors. So maybe, sell DeFi to buy the AI names, or sell the AI names to buy the L2s. So that's much more of a trading market, where Bitcoin, you have the ETF flows, you have the macro players. So that it's just a very different set of flows there.
Yeah, that makes sense. So we'd love to move to financing now, but as we do that, Zaid, would love just to get your comments on BTC dominance within your book, and kind of how the investors you're talking to think about this.
Yeah, definitely. I think BTC, from a financing perspective, remains the most liquid form of collateral and the form of borrowed asset from our perspective as well. In terms of collateral, that's where we're seeing it being used the most. And that's predominantly been driven by the fact that the key trend that we've seen over the last 6 to 9 months, notwithstanding the events of the last week, has been the demand to borrow dollars against your Bitcoin holdings. This has been driven by two narratives. The first one being the basis trade, So the basis trade is a cash and carry trade where hedge funds short, in our case, CME futures on Bitcoin, and then they go long the spot to lock in the basis between the two. The way that financing desk gets involved is that we lend clients dollars against their Bitcoin position to help them fund the margining on the short CME leg. And then the other use case is just for the hodlers out there, the people that have benefited from the price increase from last year and going into this year, and they want to make use of that appreciation without selling their positions. That's where a lot of people have pledged their Bitcoin to be able to borrow dollars and stables.
Interesting. And Zaid, would love to kind of hear your perspective. Obviously, you're in TradFi for 15 or so years doing exactly the same thing. I'm curious, like, how do you think about the structural differences between crypto lending markets today and the last cycle, and also vis-a-vis TradFi as well?
Yeah, that's a really good question. I think the listeners on the call will be aware that financing played a big part in the last crypto cycle. Not only did the abundance of capital and the high yields kind of exacerbate and accelerate the price increase, but the lack of controls and credit protections on part of both the lenders and the borrowers did accelerate that downward decline when everything basically started to fall apart. And right now, where I see the lending market is in a much more mature place, especially when it comes to CeFi and institutional borrowers. On the CeFi side of things, firstly, there's not many CeFi lenders still out there. And in terms of the ones that are left, you really need to have balance sheet and risk appetite to be able to be relevant in the space. And I think that's where Coinbase kind of stands out. We were very consistent and very true to our core beliefs in how we approach risk throughout the whole cycle. So I think we're becoming more TradFi in our view and our lens, and we're becoming a lot more mature, and we've definitely seen that follow through in the amount of leverage taken on by institutional clients.
Just maybe slightly controversial, but to kind of use a Jeff Bezos quote, "Your margin is my opportunity." You mentioned there aren't that many CeFi crypto lenders now, but there is margin there. So how do we see this market evolving? Do we think we're going to see TradFi coming in? Obviously, there might need to be some changing in regulation and things like that. But how do you feel like the space may evolve in the next few years?
That's a really, really good question. I think, like any market, you need stable and deep pools of liquidity to make that market mature, and crypto is no different. And where are those going to come from? I think that's one of the key points to kind of think about when we go into the next cycle. So from my perspective, there's probably three main places where that capital can come from. The first are some of the players that may still be around but close their lending books. So I wouldn't be surprised if people start reopening stuff. The second would be the TradFi market. I think that would maybe the first entrance would be private credit funds. We've seen some small opportunities where private credit funds have deployed capital, but I think that could well increase as they're attracted by the high yields in space. And the third would be crypto native, particularly crypto native credit funds who have performed really well this year and last year as well. And I'm expecting them to have some good capital raises and start deploying funds in the markets as well.
Yeah, I'd be curious to see what happened in DeFi as well. Obviously, we've got some pretty big financing markets there. But I guess DeFi, there's certain firms that are happy using DeFi, certain that certainly aren't happy using DeFi. But I'm curious to see how that crosses over as the market evolves. Is that an area that you think some of the more TradFi entrants will be able to get comfortable with in the future?
I think it depends. I think with the addition of TradFi participants in the market, DeFi will evolve and become more institutionalized. If we look at DeFi as a whole, lending TVL still remains like number 2 in terms of the types of categories of TVL on DeFi, and lending TVL has experienced a significant increase over the last 6 months. We're up 140% in TVL since last October, and just to pause a little bit, when I talk about TVL, I mean total value locked. So basically, think about it: the amount of capital flowing into these protocols. And yeah, the way that the DeFi lending protocols have been kind of split up right now is Aave still taking the lion's share of the TVL, but we are seeing some slight shifts, and there were some noticeable events over the last couple of weeks which have seen some changes in where people are putting their TVL.
Interesting. So I'm a holder of ETH. I put my ETH into Aave, and then I borrow dollars against it to go leverage long, or I might stake it, put that into Aave, and then take out dollars, buy ETH, stake it, put it into Aave, and loop, as we've discussed a few times on the call in the past. Now I'm interested around USD demand. We've seen a bit of a change in basis and funding, as mentioned at the top of the call. What are you seeing in terms of USD demand at the moment, and where is like a typical range of rates you might get to borrow dollars in this space?
Yeah, demand for USD is definitely the main theme, which I would say categorize the lending markets of the last 6 to 9 months, whether that be CFI or DeFi. On CFI side, I think we're seeing rates between 9% to 13%. Fairly similar on DeFi. I'd say that the main difference with DeFi, borrowing an Aave, like you mentioned, the rates a lot more fluctuate a lot more. So certain weeks they can be 6%, then they can spike to 15%. Whereas on our side, we're very consistent in the rates, and I think that's why when we talked about what would TradFi firms do, I think that consistency and stability would definitely make it more make CFI the better choice for them. That's what I would say.
Awesome, thanks, Ed. And just before we kind of move on to smart wallets, is there any other news that's particularly relevant for the financing market, or you want to run through?
Yeah, I alluded to a little bit earlier in terms of like how TVL has shifted between different lending protocols. So last week we saw the founder of MarginFi, a Solana-based lending protocol, abruptly resign, and we saw TVL in that protocol fall by nearly 50%. So that's $300 million kind of moving out of the protocol in very short order. It kind of stayed within the ecosystem, so it went to other Solana protocols, but it just shows you, that it's fairly easy to move from protocol to protocol. Whether there's a news event which moves you across, or whether it's in search for airdrop farming. People have the ability to move across quite quickly, and I think that's one of the benefits and one of the things which attracts retail and institutional players to the market.
Yeah, for sure. Just for our viewers who aren't familiar with MarginFi, it's essentially Aave on Solana. So you can borrow, lend, leverage, trade, etc., etc. But I think you're right, Zaid. Like the composability and the ability just to move in and out without docs and things like that, for those firms that can work with DeFi, is probably pretty attractive. It's interesting to see how CFI and DeFi coordinate as the space matures. Well, thank you so much for joining us, and please stay on. We're going to be having financing updates more frequently going forwards now, which is awesome. It's such an important part of the market that people need to understand about. So thank you for giving us a bit of a rundown there, Zaid.
Thanks.
Cool. And Ryan, moving on to crypto wallet infrastructure, or rather the crypto wallet ecosystem. Ryan, obviously you've been at Coinbase, is it 4 years now, I feel like?
Yeah, almost 4 years.
Wow. Well, time has flown. And you're on the corporate ventures team and kind of at the vanguard of all things DeFi, Web3, on-chain. So I'm curious, the area that you want to talk about today is kind of the wallet ecosystems. Maybe kind of give us a bit of a run through of what that looks like, and really start kind of first principles, if that works.
Sure. Thanks, Ben. So I think at a very high level, if we kind of take a step back in terms of what is the interesting innovation of the Web3 crypto space, is really around provable property rights. And so I think there's two pieces of that. One is obviously the blockchain and the ledger itself. And then secondly, it's around the cryptographic keys and wallets. And I think as crypto has become more mainstream, a lot of people have mostly talked about technology innovations on the blockchain side. So, on this show and more broadly, people have talked about new L1s like Solana, new L2s like Optimism, Arbitrum, and Base. And it sounds like there's, just like a lot of movement and momentum on that side of things. But I feel like the other sort of segment, which is keys and wallets, have actually flown under the radar in terms of the importance as well as the innovations that we've been seeing there. And I think it's actually very important because at the end of the day, this is how users and different institutions and stakeholders will be interacting on chain. And so there's been a lot of interesting developments in that front, and wanted to join to give kind of an update on what we're seeing there.
Amazing. So let's maybe just run through a few examples of how you might use a wallet. So I'm an institution, maybe you can run through how they might use a wallet, and then if you're retail, maybe just run through those two examples to start with.
Sure. So I think for the most part, if you are a retail user, you're likely downloading some sort of like self-custodial wallet client. So, a MetaMask, a Coinbase wallet, something like that, where the user basically custodies both is responsible basically for the private key. And they could sign into any application and then, do signatures to basically give permissions to sign in and create transactions. I think of it very similarly for institutions, at least on the sort of signing into the application part. It's more so the key custody part where they're likely using some professionalized custody service like a Coinbase or like a Fireblocks to abstract a lot of that away.
Got it. And the key difference there is, sorry, excuse the pun, with Coinbase, we manage your keys for you if you have a Coinbase account, whereas with Coinbase Wallet, you manage the private key and seed phrase, so you really own your crypto, and that's kind of entirely your responsibility. I will say, I think, and curious your thoughts, I think it's important that people have both. Like I have a Coinbase account, but then I also have Coinbase Wallet for things that can't be done with Coinbase, for example. Now, I guess kind of like moving slightly further forward from there, like there's different types of wallets. Perhaps you could run through that, and also just like the number of like how these number of wallets is growing over the years.
Sure. So, I think if we take sort of the number of unique addresses on Ethereum as a proxy, since inception today, we sit at almost 250 plus million unique wallets on Ethereum. What I'll just mention though is that, creating a wallet is technically free. And so that is not equated to the number of total users that are using crypto applications. But so it's not a perfect proxy, obviously, but it's a good sort of signal in terms of just like the level of growth that we've seen in that space. This doesn't include, number of unique addresses on Bitcoin or unique addresses on Solana, but you can imagine sort of similar growth trajectories for those charts as well.
Correct. And what does that flow look like? You create a wallet. What do you do next?
Sure. So in the next slide, this should explain it. So at the very first step, effectively a user would create their own wallet. So, they would have some sort of steps in terms of custodying keys and having backups for those things. Once you have that and you have funded that wallet, is when you sign into an application, they'll give you a list of wallets that you can sign in with. So, that's sign in with your Coinbase wallet, sign in with MetaMask, sign in with all these other options. And then usually you will basically be asked by the application to authenticate with your keys. And so, hey, like I'm going to sign into this application using my wallet. That is usually like an off-chain signature. And then once you're in the application, users can do whatever they want in terms of creating an on-chain transaction that the decentralized application has defined for the user. Perfect.
And can you talk us through the difference between like one wallet which kind of handles everything versus in-app and embedded wallets? And I think as we talk through this, it would be interesting for viewers and listeners to really understand, like, what does that enable? What are the new use cases that are enabled as a result of these different types of wallets?
Sure. So I think this is sort of the major innovation that we've seen in the space recently, which is this idea of sort of in-app or embedded wallets. So, the last slide effectively talked about the left side here, where you have one wallet and you can sign into any application that supports that wallet. But in that scenario, the user holds the keys and is creating the transactions themselves. And so MetaMask and Coinbase Wallet would be an example of this. I think on the right-hand side is where a lot of the new activity has happened, which is more in-app and embedded wallets. So the idea there is that a user actually doesn't have to be responsible for the total control of the keys. And what that actually allows is for a user to kind of skip that whole process in terms of creating their own wallet. And this relies actually more on the developer of the application to handle all of that logic for the user. So I think the major innovation here is that on the left-hand side, it feels very much like a Web3 sort of user experience. Whereas on the right-hand side, it actually feels a lot more similar to a Web2 style user experience, although it's still utilizing a lot of the same technology under the hood.
Great. And so where are some examples that we can actually use this, where the complexity, if you like, or untrained nature of the app is totally abstracted away, but you're using an app probably on your mobile phone, which is feels like a Web2 app, but you're getting the benefits of Web3 or on-chain?
Exactly. So I think one is just purely on onboarding. I'm sure, Ben, in your life, as you've talked to, folks that are maybe not in crypto, but want to use a crypto application, like there's probably a huge drop off just because you have to ask them to do all this crazy stuff in terms of signing up with a wallet, having the backups and funding it and all that. I think a lot of that goes away, right? So it's going to become a lot more easier for everyday users to use a crypto application, and they're not going to even realize that it's really powered by crypto. So I think one is onboarding. I think the second here is that it really utilizes the existing sort of authentication technologies that already exist out there. So, when you download an app on the App Store, for example, what's the first thing you see when you log in? You see log in with Google, log in with Twitter, log in with Discord, GitHub, or something like that. That is now actually possible, right, in this flow. So this also allows users to bring their existing data credentials and then basically create a wallet that is mapped to that credential. So you can see here now that like a lot of mobile-based applications are actually possible with crypto now because you are actually utilizing a flow that a lot of everyday consumers are used to doing when even downloading a new application.
Perfect. So where can we try it?
Yeah, so I think it depends on the applications themselves because like I said, the applications developers are the ones that have to enable this flow. But I think just some very quick sort of examples of big applications that have used this is, for example, Friendtech. So Friendtech is a Web3 social app built on top of Base. And at least in recent memory, they're probably the most famous one that we're able to get a lot of users because they used exactly this type of a onboarding flow for an embedded wallet. And they allowed people to effectively sign in with their Twitter credentials and port in that data into the application. And there's many other sort of consumer applications that are being built right now, whether that's in music, for restaurants, for eating, and things like that, which are all realizing, hey, like we actually want to target a very similar type of audience, and they are starting to use a very similar tech stack to enable that outcome.
Perfect. And so we at Coinbase released a product to help with kind of in-app wallets. Do you mind just running us through that? And if people want to use that product, how do they get in touch?
Exactly. So the Coinbase developer, Coinbase Cloud team just released Wallet as a Service, which is targeted towards developers to enable these exact type of experiences. I also want to mention that is different from the existing Coinbase wallet product that is out there, which is more of the self-custodial user-owned wallet. So just wanted to paint the picture that like Coinbase is doing both of these options. And there's a third, which is smart accounts, which is also being built by the Coinbase wallet team. But maybe that's a discussion for another time. But all in all, I think Coinbase, in terms of our role here, is as a technology provider to really onboard the next billion users into crypto. we're being very front-footed in terms of the types, not just on the chain side of things with Base, but also on the wallet side, making sure we're being ahead and creating an experience and onboarding that is going to be easy for anybody to use crypto going forward.
Got it. So we'll leave the information in the show notes, but if you are an app developer in Web2 and you want to use this software, certainly start with sales@coinbase.com, and we'll put some additional details in the show notes. Ryan, you mentioned smart wallets. We've got a bit of time here. Can you just give us like a skinny on what a smart wallet is and maybe what that enables that you couldn't have with previous decentralized wallets?
Sure. I think a little bit of history here would be beneficial. So it's kind of started with this concept of a smart contract wallet. It's been around for a while now. But I think the main thing is that if I were to compare it to, let's say, like the in-app wallet, in the in-app wallet, they're basically splitting the private key among different parties. The way that I would define a smart contract wallet is very similar in a way where you do have multiple roles, except those keys are represented on chain, right? So, in an embedded wallet example, it'd be, hey, like my private key is split between myself, some third party, and the application developer. And then in a smart contract wallet scenario, that is just represented on chain as individual wallets that all hold basically keys to what is a smart contract wallet. So just to give a little bit more history there, like it's always existed, but I think there were a couple of drawbacks, I think, to the model. So one was gas costs. It was just like way too expensive, especially on Ethereum L1 to transact and create these wallets. And then secondly, similar to kind of like the embedded wallet problem, which I think is now kind of getting solved, is just I think application developers always chose the path of least resistance to support self-custodial wallets. But there just weren't enough users on the smart account or smart contract wallet side for them to change that flow. But that's also beginning to change as well as developers are thinking about new options.
Perfect. And then, so maybe just in one line, what will we be able to do with a smart wallet that we can't do today?
So a couple of things. I think really it abstracts a lot of the on-chain components away. So just a very clear example here is gas sponsorship. There will be an idea that is natively baked into smart accounts where a third party can actually pay the gas on behalf of a new user, which is a really interesting idea because if you think about it, even if we abstract a lot of the sort of key onboarding part away for a user, they still need money to like make their first on-chain transaction, right? I think with smart accounts, that can actually be abstracted away where the developer themselves or even the chain itself that is benefiting from these transactions is willing to cover, let's say, like the first 5 transactions for every new user based on the smart account. And I think that's a very interesting area of exploration. And I would just also point out that the Coinbase Cloud team also has an account abstraction kit, which is targeted towards these types of use cases.
Okay, that makes a ton of sense. The amount of times that you try a new chain and you have to send the native token to the wallet first, and then once it's there, you can then kind of get on with actually using it. So account abstraction makes it feel more like Web2, so you don't need to pay that additional cost. I mean, even with Instagram, Meta, whatever, you are paying for server costs somewhere. It's just you're not paying upfront, and then I guess it's making it more like Web2. Great, awesome. Thanks, Ryan. Any other bits you want to cover before we wrap there?
No, that's it. I think if folks are interested, Coinbase Ventures is publishing a lot of our research in these areas and others on our blog. So just go to our Coinbase Ventures website, and there should be a blog tab for folks that want to read more deeply into some of these areas.
Perfect. And for those that want homework, check out FriendTech, Blackbird as 2 options to try out what an in-app wallet looks like. Cool. Thank you very much, Ryan. Great to see you as always. Zaid, awesome to have you first time. David, welcome back again. Great to have you. And Greg, as always, thank you. We're going to call it a day for today, and we will see you next week. Good luck out there.